Right, now to monetary policy. If this week's inflation data is any indication, the end of rate hikes may be within sight. The Consumer Price Index, a key inflation gauge, up 4.9% from a year ago, just a touch lower than March's 5% figure. Now, of course, you also have the Producer Price Index, which the Fed prefers. That rose 2.3% on an annual basis, below estimates and the slowest annual increase since January. And of course, markets pricing in an 84.7% chance of a pause in June as of this morning, and that's down slightly from the prior day. With 1 month to go until the Fed's next meeting, our next guest is keeping bullish in the near term, raising his target on the S&P 500. Barry Bannister is the chief equity strategist at Stifel, and he joins us now. Apologies there. We're going to be focusing on the consumer. David Waddell joining us now. Thank you so much.
I can be Barry, if it makes it easier.
No, David, we're happy that you're on. We want to first talk about the state of the consumer. You have this, this number that really shocked in terms of the Michigan sentiment here. And considering that consumer spending makes up 2/3 of a US GDP, I mean, where are we now then in the conversation about how the consumer is actually faring?
Well, we have to remember the Michigan Sentiment Index really only surveys like a few hundred people. So I'm not sure it has the teeth that some think it may have. Maybe did drive the dollar up a little bit and interest rates a little bit higher because the inflation expectations were higher. But if you look at the consumer overall, they're doing pretty well. I mean, the unemployment rate at 3.4% is certainly constructive. And they still got a lot of net worth left over from all that stimulus spending. So what's keeping us from falling in recession has actually been the strength of the consumer. So to a certain extent, for the Fed to achieve its objective, they have to stop spending. And we're seeing, some of that maybe cool off a bit, but with unemployment this low, the incentive to spend is still there. But sentiment is coming down, and sentiment does drive discretionary spending decisions. So I would expect that to cool as the economy continues to cool into this quarter.
And I mean, we've seen people pouring into tech at the beginning of this year, but you noted that 2023 so far has burned the adventurous. So what are some of the trends that some investors are following that you're not willing to chase?
Well, I mean, for instance, the S&P 500 is up 8% year to date. The equal weight version of the S&P, because the S&P 500 is so overweight the FANG names, the equal weight version is unchanged. The Dow Jones Industrial Average is unchanged. The Russell 2000 is unchanged. So if you take out the large tech names, the indices represent more of a depiction of what's happening in the economy, which is softening, and in earnings, which are negative, and in obviously the political paralysis with the Fed pausing and the debt negotiations. So the only thing that's keeping this market aloft right now is tech. And so for those who tried to get adventurous and go outside of the indices, it's been a very difficult year because there's been so much sideways action, and it's just hard to catch any trends. And maybe the tech trend's a little bit exhausted. If you think about the seasonality, you sell in May, you come back in October, that may play out a little bit. Perhaps there's a reversion to the mean. The spread between the S&P and the Dow is pretty wide historically. So maybe you get a little bit of the tech names coming off boil. Some of the AI hype sort of dies down. And we spend the summer sort of rationalizing tech versus everything else.
And so then when you compare what we've seen from the University of Michigan sentiment here, but then also what we heard from a lot of CEOs on these earnings calls about the resilience of the consumer while still keeping an eye on some of the issues in the banking sector still not being worked out at the moment, what are some of the concerns that you're hearing from clients?
Overall, our clients have taken this in stride, more so than I think they have in the past. I've got gray hair. I've been at this for a while. And when the market sells off 25%, like it did last year, we typically get a lot of calls for people trying to jump off the train. That really wasn't the case this year. So I don't know if we're doing a better job, forwarding financial planning, or if people have gotten a little bit more resilient, understanding the knee-jerk activities in the market. But we're not really seeing panic. We're seeing a little bit of boredom. People starting to think, well, should I look at gold? Should I look at some other yielding assets? Maybe I'll take the 5% I can get in money markets and not worry about this. And to a certain extent, I can understand it. If you're going to put money in the stock market for the next 3 months, don't do it. The recession's going to show up. It's going to continue to be somewhat anxious. But if you got money that you can hold for 3 years in the stock market, do it. The stock market will likely be I don't know, earnings are supposed to be 275 at the end of 2024. You put a 19 multiple on it and you're 27% higher from here. So they understand that we got to get through this recession, that most likely it will be mild, and then recovery returns are always really great. So why not just hold and wait for that occurrence? In the near term, it's anybody's bet with what's going on in Washington. But looking past the recession, things should be pretty good, I think.
And so then if you could think of just two things that you put in your criteria for how you're gauging this environment for better outperformance odds against, say, the S&P, what would they be?
I mean, that's really hard to do. We have inside markets and outside markets. This is a market right now where the S&P, because it's so weighted towards what's working, which is large cap tech, is really outperforming everything else, mid caps, small caps, et cetera. So the only place we've been able to find alpha or index outperformance is actually offshore. So the EFI's done great. And it's done great for every period going back over a year because we all expected Europe to be, left for dead once you had the invasion of Ukraine. And in fact, the opposite has happened. They sort of skated through that issue. They got their house in order. Earnings have been better there than they have been here. And GDP growth has been better than expected. So, the difference between reality and expectations is really all that matters. And the reality offshore has been a whole lot better than the expectations. And just to put a finer point on that, natural gas is down 50% this year. Wheat is down 20% this year. So these things that we were super afraid of that would tank Europe didn't come to pass. So very hard to outperform the S&P here unless you're in the NASDAQ 100, which is up 23% this year. Offshore, you can outperform it because Europe has actually outperformed and Japan's done fine. So international equities have outperformed, the NASDAQ's outperformed, everything else is underperformed.
We'll certainly be keeping track of all those trends. A big thank you for joining me this morning, David Waddell, Waddell Associates CEO and Chief Investment Strategist. Have a great weekend.
Great to be with you. Thank you.